one of the most well-established narratives over the last decade. I think that's what a lot of the smart beta growth was on. I like your phrasing of crowdedness. I am curious, though. I mean, again, a lot of these trades have now become prepackaged and available in a way that they weren't 30 or 40 years ago. Yeah. Even if I knew about fallen angels as an individual, it was very difficult for me to put fallen angels categorically in my portfolio until Van Eck launched an ETF. And now there's hundreds of billions of dollars chasing these structurally, which is going to have a reflexive impact upon whether these premiums can even continue to exist, right? Because there was a consistent set of, or not consistent, but there was a supply and demand imbalance. And now all of a sudden, we've eased access to one side of the trade. And I don't think there's more people on the other side of the trade, right? So you would expect the premium to diminish. I'm curious as to where you think blue ocean remains in this space, because to me, it seems like a lot of the empirical evidence would suggest that the premiums have been dramatically squeezed over the last decade.
Right. Would you say that those trades are getting crowded?
Absolutely.
Okay. So this is like, and this is it. They're anti-crowded trades that themselves have gotten very crowded, right? It requires a gradient differential. And what happens if enough people come to here? What happens if more? Like if you're going to buy insurance and there's only 2 insurance companies, they can probably charge you a pretty hefty insurance premium. They're going to charge you some fair fat amount. If you come back and there's 50 insurance companies offering you insurance, presumably that's getting squeezed pretty hard. And if one of them is like crazy and wrong, maybe you can get it for like less than it's worth. At the moment, these anti-crowded plays themselves have gotten shockingly crowded, and that has really, really hurt the space. And that commoditization of the space is the main challenge and the problem. But it's not. And so my point is, it's not just hurting the systematic guys, because the discretionary guys also kind of do the same stuff and have for a very, very long time. And so in many ways, it's hurt everyone. And like I said, if it's not a buy high, sell higher markup type of trade, like it's a very, very hard space to be in. So what we started doing was, I would say this is even back in 2010, 2011, when I first started like the bones of my first sets of ideas around this, was thinking like, oh my God, the space that we're in, which has done really well for us. And we had a great narrative back in 2004. Because back in 2004, this narrative, like when we put it out there, the response was, and I had a very, very supportive set of bosses like Wayne Cozen and Mike Witzel and Neil Petrov. Like they were all like, they gave us unbelievable amounts of time and leash, and we built some like really good stuff, and it went really well. And I would say, like at that time, I think we put together something pretty like relatively innovative, relatively early for a pension plan. But by 2010, 2011, I was hearing the same story that I just told you back at me from everyone. And it was other pension. I mean, I talked to tons of pension plans. Like, you guys should all be doing this, And I talked to other hedge funds, and you heard it from bank products started really like coming out, like you said, like in the ETFs, and so this story, which was in itself an anti-crowded story, began to get extremely crowded. And I went, what are we going to do about this? Because this is our space. This is going to cause problems. And so, like the first thing, and like I said, you're always innovating. There wasn't like now we're on to the next thing. It was a constant, like, what can we do about this, and how do we take advantage of this, and what are the implications of this? And so what we really started to like think about was like, how can we take advantage of this crowdedness in this space? Because like when I said, you talked about those structural guys, the ETF who's following a set of rules and doing something, everyone's doing the same rule at the same time. What was very apparent to us was that everyone was doing kind of the same things. This is like the beauty of systematic investing and the massive challenge of it. And like I say, once again, not just like all investing, like doing something similar, but if you're a trend follower, and like we built a CTA. Our CTA had I think at first 5 different models, right? We had a moving average crossover, breakout, some regression slopes, like regression crossover, like serial correlation, and like different ideas. And very early on, we were doing an ensemble approach with all the different parameters we can come up with. And the kind of weird thing was like they were all like 80 to 90% correlated, right? They all did roughly the same thing. And really, when a big trade came, they all were trading at the same time. And then we went to talk to managers, because one of the things we're doing at Teachers is we had a external manager portfolio. We went to talk to managers. And we'd always be very careful and say, like, we're running a prop shop, and we have but our filter was typically send us your daily returns. We'll regress it against our internal model suite, and we'll see who's doing something different. And the sort of the crazy takeaways, you got 200 sets of returns. Like you could fully explain 170 of them with with what we were doing. We had a very scorched earth approach, and so it was like, oh, our models are saying that they're all kind of the similar. When we talk to managers, they're all kind of doing the same sorts of things, and we were looking for the crazies doing like stuff like a bit different that we couldn't do. But like the takeaway is like this stuff that we're doing. If I'm buying crude on a Wednesday morning, like so is everyone. right? I have a pretty good sense of what like a good chunk of the world is doing because I've been running it myself, and I have a pretty good sense that that's pretty indicative of what a lot of other people are doing. So it wasn't like I can go back and say like I know what everyone else is doing, but I say I've got a pretty good indicator that my model suite has gotten crowded. And so can I start staring at my own model suite and start to look at the implications of how different bits and pieces interact, and when has something gone full, and when has an asset got crowded, when has a model got crowded, when have parameters within assets within models gotten crowded, and start to get a sense of like what are the implications of that? Because once again, when anything gets crowded, you know, you want to get on the other side of that trade. If you can find the relatively uncrowded piece, you can build a long short book, right? And you can build long short books because when something gets crowded, either its returns get driven down or its risk gets driven up. And you can build a long short book by two things where I think this guy's got higher return than this, and I have no view about risk. You can build a long short book where I go, I have no view about return, but I think this thing is riskier than this thing. So this is higher, like this is lower Sharpe ratio, and this is higher Sharpe ratio, and I can still build, you know, a flow of wealth between a higher Sharpe ratio and lower Sharpe ratio just by focusing on where I think the sources of risk are. And so, and we can start to like, we can look at the asset level, and look at the parameter level, the model level. And so we started to build a ton of anti-crowded models within the alt risk premiums themselves, right? And the key feature about that, and the kind of the cool part of that, is that they are themselves alt risk premium neutral, and they're also beta neutral. So you know, you're equity fixed income neutral on average over time, and commodity neutral over time, but you're also trend following neutral over time, and it takes a lot of work, and keeping it that way is challenging. But we have like these, you know, these 20 models, and you know, the key feature of them is like they're properly uncorrelated, because like the average cross correlation term over the last 3,500 days is like 0.03. So like they're properly different from each other. And so, and then of course, like anything, it becomes a portfolio construction and risk question to make sure that you can keep those guys uncorrelated and keep them diversified and size them right, and build a trusted portfolio.